Hey, in this video we are talking about how do you know if you have enough to retire? What are the steps you need to take to figure out that answer? We're also going to look at a case study to show you how small changes, either good or bad, can have a big impact on the outcome. Coming up next. Hey, my name is Mel Stubbs. I'm here on behalf of Retirement Benefits Institute to talk to federal employees about their retirement. Today we're talking about how do you know if you have enough? There are people out there that have $1 million in their TSP, and when they retire, it will be enough. But there are others that also have $1 million in their TSP, and if they retire, it's not enough. A lot of it comes down to your spending. So let's look at what's going to make up your retirement income. First, you've got your FERS pension. You need to know what that number is. Reach out to Retirement Benefits Institute and they can prepare a report that will show you what this number is. But you need to know what your FERS pension is. You also need to know what your Social Security amount is going to be. And then you need to know what kind of withdrawal can you take from your assets. How much will your TSP enable you to take out every month in retirement? Those are the three things that you need to figure out in helping determine this answer. Now this is a simplified look, and so we're going to get into a little more detail. Most people do this figuring and they figure out that, you know what, I think I have enough to retire. But there are different scenarios and different circumstances that you need to plan for. Let's just say that the tax policy changes and taxes are much higher. That means the taxes on your pension is higher. The taxes on your Social Security will be higher, and then the taxes on the withdrawals from TSP will be higher. If you still need to live on the same amount of money, you're going to have to increase your withdrawals to make up for all these increased taxes. That can cause you to run out of money faster. So you need to look at a scenario with taxes much worse and see, do you have enough money in this scenario? Let's also look at investments. Let's say that you're not as diversified as you need to be. There are arguments and articles you can go read that says the TSP is not as diversified as you will need it to be in retirement. But let's say you're not as diversified and 2008 happens and you lose a bunch of money. Well, now you still have to withdraw the same amount monthly to live, but now your balance is much lower. Can your plan handle a big loss in retirement? You need to look at a scenario that shows that and make sure that you still have enough money in that scenario. Another scenario to look at is what if you or your spouse dies early? Will the remaining spouse be able to make it into their 90s? That's a scenario you need to look at. Now, all of these scenarios, if one of them happens and it doesn't work well for you, there are steps you can take to fix it, but you need to be fixing it now, not later. You need to know there's a problem now, not later. So we're getting ready to look at some software, financial planning software, that will show you some of these nuances, because there's multiple scenarios you need to plan for. And if any one of the scenarios does not work, then your plan doesn't work and you don't have enough yet. You need to take steps to fix each and every scenario so that they all work well, then you have enough. Let's jump on the computer and look at it. So we're at the computer, we're looking at some financial planning software to go through different scenarios of the same individual. Now the person will have the same amount of TSP, in this example $500,000. They'll have the same pensions, same Social Securities, the same rate of return. So the assets will grow at a same rate. The only thing we're changing is your expenses. What are you spending? And let's see how that affects the plan. So in this first plan, you will see here, there's the $500,000. Come over here, here's some of the FERS pension. Social Security kicks in later. You see the investment return, about 5%. It goes over taxes, and then here's where we put $60,000 a year is what you want to spend. If we just look at the picture, this is the assets they have starting at $500,000. You see the assets growing, they have plenty of money. Another thing I want you to see here is look at this spending. You see how $60,000, $60,900, it moves up. So down here in your 90s, you're spending $85,000. Inflation is real, and the program shows that. You want to make sure you have that built in, because your pension does have cost of living. It's probably not as much as inflation, but it has something. Your Social Security has a cost of living. It's probably not enough, but it's something. We've got to earn some money with your investments to keep up with inflation. So here at $60,000, dollars a year of spending, you see this person is fine. They're dying with $4.5 million. That one works. So let's switch over. This is somebody spending $100,000. So if you come down here, the same $500,000, same income, same returns. The only thing we changed is let's spend $100,000 a year, not $60,000. If you see they don't run out of money, they still have it, but they're dying in 2054 with about $400,000 of money. Now remember, $400,000 won't be the same as today's $400,000. So this is probably cutting it a little close, but technically it does work where this person could spend $100,000. Now let's switch over to now this person is spending $110,000. Only thing that changed. Still got $500, still has the pension, same returns. All we did was start spending $110,000 and then let inflation take over. And you can see they're dying out here in 2051 and 2054. The money is running out way beforehand. So this is an instance where they are spending too much for what they have. Now there's several things you can do to fix that, but this scenario is not working. And you would like to know this information now, not later. We need to know this in advance so that you can do some better planning to avoid this. Okay, another scenario to look at. What if the spouse, here the husband dies first? So in a year or so, the husband dies. 2021, the husband dies. You can see here there's $250,000 of life insurance. So they get a bump in assets. But still, the wife wants to spend $100,000. And this worked when both of them were there. But when the husband dies, remember the first pension gets cut in half. Social Security, one of the two Social Security goes away. You need a plan for that. This obviously doesn't work. You see the bump in assets because of the life insurance, and then, she runs out of money fast. So in this scenario, if they both live to their 90s, $100,000 a year works. They can spend that much. But if one of them dies, if the FERS employee dies, it blows up on them and they don't have enough. You need to look at different scenarios. We could go to another scenario and increase taxes a lot, see if it works. There's all types of scenarios that can be run to make sure that your plan works in every scenario. That's the key. It has to work in every scenario. So going back to a simple version of it, income minus expenses, your budget, equals the shortfall that you need to fill with your assets. There are three ways you can make this better. You can make your income higher. To make your income higher, you're going to have to work longer. You need your FERS pension to be higher. You need Social Security to be higher. That's your options at fixing that variable. Your expenses. You can control your expenses some. Maybe you need to pay off some bills before retirement. Make sure your car and your house payment work in retirement. There's even some things you can prepay. A lot of times people want to have a life insurance in retirement, but they don't want to pay for it in retirement. So while working, you can pay a little bit extra and kind of have it paid up. So by the time you retire, you don't have the payment anymore. You have some control on the budget. Now, the third thing is assets. If you need to take out more money, you need more assets. You can either contribute more while working, or you need to earn more. So maybe you have to take more risk. Now, obviously, you need to sit down and talk with someone specific about what you need for your plan, but the only way to get more assets is to save more or earn more. Of these three, you can see the one that you have the most control over is the budget and what you're spending. So to make sure that you have enough, you need to know your numbers. You need to know your pension, you need to know your Social Security, you need to know what assets you'll have in retirement and then how they might grow. You need to figure this out over multiple scenarios. If you and your spouse live to 100, does it work? If you and your spouse spend $50,000 a year, does it work? What about $80,000 a year? Does it work? If one of you dies early, let's say next year, does your plan work? What if you have a long-term care health event and you need to start spending an extra $30,000 a year? Does it work? There are things you can do to fix each of these problems. So if any of these scenarios don't work, there's something you can do now to fix it. And you're going to want to do that before you retire. So to learn all these numbers, reach out to Retirement Benefits Institute. Get the report that they have that will show you all these numbers. Somebody will sit down, go over it with you, help explain these things. And if you want help talking about the different scenarios, just let them know. This is too important to leave to chance. You need to know your numbers to know that you have enough. My name is Mel Stubbs. I'll see you next time.